Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is Your Course to Retirement, brought to you by the team from Cornerstone Retirement Partners, Grand Rapids resource for guidance, insight, and perspective on your money, helping to uncomplicate the financial, the investment, and the retirement planning world. And we always appreciate the perspective of Certified Financial Planner, CFP, Ron Corser here on the program. Ron, great of you to join us again to have a little conversation about our money and about the market today.
Important stuff. Well, good morning, everybody listening to today's program. Those of you on your way to church, please don't take notes. You can always go to our website to download today's presentation and show. Go to www.cornerstone-rp.com and you can download the whole program or just parts of it. For those of you who are sitting comfortably in your own home, waiting for spring to come in Michigan, I've been assured that it is coming, but we know that living in Michigan, it doesn't mean it could be here tomorrow or it could be here around July 4th. So, we can just hope and pray that that works out for us. But we're going to do a deep dive today on the stock market. Now, I'm not going to do an imitation of Jim Cramer. But what I am going to do is try to talk about some really basic ideas that everybody should probably hold on to and mull over when it comes to investing their life savings in the stock market. It's interesting. One of the things that we seem to believe that the stock market gives us is certainty, because it's always around. We've been doing this all our life, investing in IRAs and 401ks. But when we really just sit back, take a deep breath, do we really have certainty? One of the interesting things, I think, in mountain climbing, I got a good buddy in this business in New Jersey that used to be a serious mountain climber. The only mountain he finally gave up trying to think about climbing was Mount Everest. He was that kind of a climber. But he told me something interesting, and I believe it, is that when people go and try to climb Mount Everest, it's very dangerous to do. You got to be in great shape and you got to be a little lucky. But most of the people going up the mountain, whether they get to the top or get to a point where they stop, they get there and they seem to get there in reasonably good shape. The problem comes when they try to go down. Most of the people who are mountain climbers who are trying to climb Mount Everest die on the way down, not on the way up. And I guess the moral of the issue is that they really didn't do enough planning for the second half of their adventure. The first half is going up, the second half is coming down. And a lot of that has to do, I think it's a good analogy for our retirement planning. A lot of us are pretty good at going up that retirement mountain. We can save 401ks, IRAs, watch what we spend, try to save more than we're spending to get ready for that thing at the peak of the mountain called retirement, however you visualize it. And then the problems really start to come, because once you stop working or in that thing called retirement, the dynamics of saving, investing, and everything change. Now, most of Wall Street will always tell you, just keep investing in the market, trust the market, because the market always goes up, even when it comes down. Over a long period of time, it will always go up. And that's absolutely true. It's demonstratively true. It will always go up. The problem comes, well, if I just retired and I take a 25% loss in my retirement income, and I have to take money out of my retirement income, am I going to be able to recover? So that's a real interesting question, and everybody needs to answer that. Every Wall Street firm, Fidelity, Vanguard, always tell you stay fully invested and everything is going to be just fine. And yet we know way down deep behind our belly buttons, we know that perhaps is not exactly accurate, And we also know some people that perhaps have retired just before a major correction or bear market happened, and their retirement plan has really been destroyed. So a couple of things we need in this discussion that we're going to have, and I mean, we need clarity. We need to understand, we all do. I do, you do, Peter, everybody listening to this program, understand how money works in our life. That seems like a pretty simple thing, but it's much more complicated. Why? Because you, Peter, me, and everybody listening to this program, we're all uniquely created by God, and we have our own vision and our own thoughts about money. So we need to understand how it works in our life. And once we do that, maybe understand why some of the traditional thinking when it comes to stock market investing sometimes doesn't work. Sometimes it just flat out doesn't give us what we're looking for or what we need. So the first thing we need is clarity. The second thing we need is certainty. You know, why are all the problems? This is a great question. Why are the problems we face? That can be risk, taxes, regulation, inflation, deflation. Those are certain in our life, aren't they? We know those are there. We see them almost every day. We know about them. And yet sometimes the solution that we seek for all of this certainty is in itself uncertain. We want to bet all the problems, all the solution for all the problems on the stock market. And the stock market in and of itself is neither good nor bad. I'm not here to badmouth the stock market at all. It's just a whole lot of uncertainty. So we have a bunch of things that we know is going on, risk, deflation, inflation, taxes, all that. Those are certain. And yet we're trying to use an uncertain situation or an uncertain boat, so to speak, to navigate those waters. And then the third thing is
it's a tool, right? A tool that we have access to. And overall, I would say it's a pretty effective tool, but not every tool is right for every job, nor in every situation.
It's absolutely true. And so finally, we need clarity, certainty. We need the ability for financial restoration. What does that mean? If we stay invested on our lifetime in a market with some or all of our money, we are going to experience a loss. That's just what happens. So the ability to catch up on those losses, to recover from them is really important. And it gets down to when we think about our money and we think about investing, we think about the future, we think about retirement, it really gets down to a really simple idea. We're either going to inherit as individuals all the challenges, all the problems, all the certainty of taxes, inflation, deflation, market corrections, all that. We're either going to inherit all of that or work with an advisor who's going to provide the ability to inherit solutions. So that's where we're going to go with today's program. I hope everybody stays tuned. We won't go deep into the weeds, but I think we'll talk about a lot of things that'll bring clarity to what we're talking about, the idea that it's possible to have certainty, and also the ability to recover if we meet a bump in the road or something goes wrong.
Well, I like your analogy and the story and lesson taught by the discussion of Mount Everest. And I want to address and not overlook the fact that the charts of the market sure look like mountain peaks. And you're right. It's like the way up on the direction when it's heading up. That's really not the part that a lot of people find harmful. It is those downturns that ends up being harmful for many of us. So that's what we got to look out for. That's what we have to plan to be able to successfully navigate. And Ron, we have seen an uptick in market volatility and instability. And I noticed another thing you subtly mentioned, and I don't want to overlook it, is that you referred to people's life savings in the market. It's one thing if we talk about our money in the market or our investments in the market, but when we talk about it in the context of our life savings in the market, that's going to invoke a lot of different emotions. And just because we see market volatility, it may not necessarily be a bad thing. But if we have our life savings tied up in it, it is going to invoke an emotional response.
Yeah, it really does. Money is emotion. Unless you got a gazillion dollars and you're Jeff Bezos with Amazon, I mean, I don't think money's an issue for him in any part of his life. For most of us regular folks in America, money is an emotional issue. It really is. We've worked hard all our life to save. We don't want to lose. You know, if I ask a simple question to you, how much money are you willing to lose in the stock market going forward? Most people say, I don't want to lose any. That's a pretty rational response.
Interesting. And then yet we have our money invested in the market where we know there is a possibility of losses.
And if you stay in the market long enough, you'll experience some of that.
Yes.
That doesn't mean it's going to destroy your life savings in your retirement plan. It could, but it doesn't mean that. It's kind of like going to my brother. I love him dearly. He goes to Las Vegas every year, twice. And he goes because he says his wife, my sister-in-law, likes the shows. My brother could care less about the shows. All he wants to do is gamble. And I once asked him, I said, Rick, how do you do out there? I mean, do you win? Do you lose? But he says, well, I pretty much, I do okay. I win, but my wife, she loses all the time. And I say, well, how much is that? She says, well, I know how much I can lose. And I said, well, how much is that? And he doesn't have an answer. He doesn't want to give me an answer. But he let it slip one time, and I dearly love him. He takes about $25,000 every time he goes to Las Vegas. And a couple times he's come back a little less heavy than he went out. But see, it's amazing when I've talked to people and they say they go to a casino. Invariably, a lot of them will say, well, I know how much I can lose. And if I keep asking, and I don't do it a lot, I found out that invariably that's what they did lose. So the good news is they put a stop loss, so to speak, on their losses at the casino, but they don't do it on their money in the stock market. It's kind of an interesting dynamic. So let's talk about the markets, the instability, what we should think or not think, anything like that. Because I think if we explore this whole idea of investing in the stock market, it'll help bring some clarity to folks, and it'll help bring some certainty and also an awareness of what they can or can't do or should or shouldn't do that will make them comfortable. And keep in mind, ladies and gentlemen, if you want to talk more about this, because I think we're going to be able to share some really great information and slides with you, give us a call at our office, 616-301-2581, 616-301-2581, or please go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Just put your name or number in there and we'll get a hold of you and help you any way we can, give you information that you need. No obligation to it. And we don't chase or harass people if they do that for us. Our job is to help. It really is. So let's go forward on that one.
Well, and I do want to mention that if you are listening to the radio program and that is the normal way that you experience the show, that there is an archive available at cornerstone-rp.com. There are also episodes out there on your favorite social media platforms, on YouTube, and oftentimes during the program, we may reference a guide or a report or a resource or an article, or like today, some charts. We try to include those things in the links below the videos in the description or in the description on the podcast page. So there's more to the program. You can always find more. You can always find out more. And the best way to do that, as Ron just mentioned, is just to call Cornerstone Retirement Partners and have a direct conversation about any questions that are on your mind. But if you'd like any of the resources that we ever discuss on the show, definitely take that trip to cornerstone-rp.com and check the videos and the podcast out there and the descriptions below, because a lot of the resources that we describe are included. We try to give you ways to access that on your own comfort, convenience, and make sure that you are getting information to make informed decisions with your money. And that's really what it's all about, Ron. I mean, the reality of the question of will markets go up or down into the future? Yes, they will do a little bit of both, but it is our approach. What will I do with my money when that happens, or what impact will that direction have on my thought process, my behavior, and my emotion about my money when those different circumstances happen, that really is going to dictate some of our attitudes, some of our answers about what is appropriate to actually have invested. And then, Ron, I think what we're going to dive into on the program today is a little bit of separation of fact versus fiction. Like, what is the reality of what happens with our money versus what have we been told? What have we been taught? What have sort of been the prevailing wisdom? And can we put any faith behind that? Or do we maybe need to rethink and re-educate ourselves a bit?
Yeah, those are great questions. And one of the things we always need to do is sit back and say, okay, my money, the money that I've worked so hard for all my life savings, is it an end unto itself or is it a tool? Which is it? I'm always, as a kid, I used to love to read Donald Duck comic book because there was a guy in there, actually a duck, he wouldn't be a guy, called Scrooge McDuck.
My superhero.
And he used to have this big vault of money and he would go swimming in it. The money to him was an end in of itself. He just loves swimming in it and diving in it and rolling around in it. For most of us, money, we kind of want to be able to do that, to roll around in it because it's always locked in a vault, but that's not the fact. It becomes a tool. And if we understand that it's a tool, then the tool has to do something for us. And when we think of tools, and I'm the kind of guy, believe me, in real life, if I can't fix something with a hammer and duct tape, I'm in deep doo-doo. I got to call somebody for serious help. And my wife knows that she can fix things and I can't. But if money is a tool, we have to recognize that every tool has a specific use and every tool has a limitation. You can't use a saw to pound a nail, at least not efficiently. You can't use a hammer to cut a board. You can't use a screwdriver to basically dig dirt and plant flowers. I mean, I suppose you could, but it's pretty inefficient. So the question becomes, I have this money and it's a tool. So how am I going to use this tool and what am I going to try to achieve or accomplish with it? So what's the right approach for this tool in the market? We've been told all our life that the stock market basically is the solution to most of our problems. But let's just sit back for a moment. Take a hold of the idea that money is a tool. Let's just examine this for a minute. What do we know that's going on right now in our lives? For those of us who are not yet fully retired and not in the Social Security system, we've been told that probably by around 2033, 35, somewhere around there, in about 13 to 15 years, the Social Security system is going to be running on an empty tank, and they may only have enough money to pay about 75% of the benefits. So there sounds like there's an adjustment. I don't believe that they're going to cut our benefits if we're already in the Social Security system. I could be wrong. I just don't believe they'll do that because Social Security people are voters. And if you start cutting the voters' money, they will vote you out of office, which is the really critical issue here. So, but they are going to make some changes. They could make changes on how it's taxed. They could make changes in whether they're going to have cost of living increases. There's a lot of ways to massage it. But we know that in retirement, that is a predictable, what we call permanent cash flow issue in our retirement. What do we need in retirement? We need income. Here comes people are going to, somebody's head's going to explode with what I'm about to say right now. We don't need growth in our retirement money, number one. We need income in retirement. We need to make sure that we've saved enough and we have an access to a pension, perhaps, or Social Security, that we have enough income in retirement to retire and maintain our lifestyle.
And Ron, I think that fact has been subtly recognized, but often overlooked. I mean, the old mantra about retirement was not grow the most and take the most income. It was protect the principal and live off of the income. There wasn't a growth factor that was included in the age-old way that people thought about what to do with their money and what they needed from it in retirement. Now, if we can get a little growth, no problem. But in order to try to achieve that, there's risk involved. And I think that what that saying of protect the principal and live off the interest kind of alluded to is that that is a time in our life where maybe the risk is not as appropriate. And so if we're younger, like you said, if we're still saving, yes, nobody likes to see downturns, but it actually could present us with an inherent advantage over time. Whereas if our life situation and circumstances have changed, if our needs have changed, then the approach that we are taking to utilizing that tool that is the market, that is our money, probably needs to change as well if we are hoping for a little bit of a different outcome.
Well, that leads me into an interesting kind of thing to talk about. When I go back, when my mom and dad were alive, they worked at General Motors. They did a whole bunch of years. When they retired, they got a GM pension, they got their health care paid for, and they got Social Security. And the high-powered investing my mom did was to buy CDs. I've talked about it on the program. But back then, you could get CDs that paid 5 or 6 or 7%. So it was possible to live off the interest and leave the principal alone because they had enough protected permanent income coming in between pension and Social Security. They didn't live extravagant, but they lived good. I mean, it covered their lifestyle. So that was then. That was back in 1970. All right, let's just go 50 years from now. Very few people have pensions. Very few. So that has almost eliminated one source of income or cash flow in retirement. The only thing we have left now is Social Security, and we've been told that it's a little uncertain. So that's one of the predictable pieces of income we have. Now what we have to do, because even a lot of people who have pension plans, that's been converted by their company into 401k plans, now all the risk is on them to make sure that this retirement savings vehicle called a 401k or an IRA generates enough income in retirement to make sure they maintain their lifestyle. Well, if the market always goes up, you're going to be okay. But if the market doesn't always go up, we know that, we might not be okay. So the real issue in terms of investing for the future, yes, it probably makes some sense to take a portion of your life savings and have a solid, rational investment program or strategy in retirement. But it also may make some sense to take a portion of your life savings and put them in vehicles, investment vehicles, that will provide you guaranteed, you cannot live at protected income. We'll talk about that maybe on next week's program. But what I'm talking about is creating a pension plan type of an income for yourself using annuities. And I know somebody's head just exploded out there when I used that term, but properly used, annuities might be very beneficial to some people to provide that pension substitute for predictable income. So one of the things you have to understand is if you're going to be a stock market investor, the market's going to go up, the market's going to go down. Blessed be the name of the market. Now, the real problem with investing in the stock market, and if I've kind of touched somebody's interest right now, please give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Say, just put your name in there and say, I want to talk to somebody, or I need clarification, or I need information. Whatever it is, we'll help you with it. Because I think it's important. We're not living in 1970 anymore. So that may be good in a lot of ways, but financially, it's a little more spooky. It's a whole lot more uncertain. And if we're going to live 25, 35 years in retirement, trying to get certainty, and I talked about that at the beginning of this program, is really, really important. So when we think about what's the facts, what's the fiction about the stock market, let's take a look at some of those things. And I think you'll find it enlightening because we're going to share some slides. We're going to share some data that perhaps will go against what we've been told by a lot of Wall Street firms. All we're going to do is just share actual numbers. It's nothing that we're going to massage. We're going to show you what the base is, where we're starting from, and where we're ending. So you can see the real rates of return, the real issues involving risk, market volatility, and things like that.
Ron, it sort of struck me when you mentioned how long ago 1970 was, that we're 50 years past that. And sometimes newer generations sort of dismiss the way that older generations did things. Oh, that was for them. That was for the old fogies. But I don't think that we can overlook the fact that the last generations retired with a higher level of financial confidence very often than the current generation is retiring with. There wasn't a question of running out of money when they had the pensions that were provided by companies, plus the security of a social security system that was at that time not so much in question or in jeopardy. And they had their personal savings, yes, to supplement, but there was a lot of financial security in having those baseline streams of income to cover expenses. Were there problems? Were there issues? Were there deficiencies? Yes, there were, but overall, there was a much higher level of financial confidence and well-being that retirement income was going to be taken care of.
And when I think back to 1970, 50 years ago, not that many people are invested in the stock market. When you think about it, 401k didn't come into existence until the late 70s. Same thing with IRAs. Mutual funds back in 1970 and before that, most of them were commission-based and had an 8 to 8.5% commission. People would lose their mind now if that were the fact. But there were a lot of people that didn't invest in the stock market. There was no need to, because they had the bank stuff that they could hold on to. So let's talk about an interesting concept, okay? Do markets go up and down? Bear markets are real. What are bear markets? Things like that. Right after the break, we're going to get into it. I'm going to talk a little bit too, something called sequence risk. So give us a call, ladies and gentlemen, at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there. We'll contact you as fast as we can and help you any way we can. So let's go forward on that.
Yeah, a lot of great information still to come on your course to retirement, a lot of numbers that we will go over, really examining the reality of the market, a lot of educational information coming your way. So don't go anywhere. There is much more here on the program. We'll be talking with certified financial planner Ron Corser about the market, about expectations, about where expectations meet reality and where the two may differ when we come back. But always the value of the program, your opportunity to address your specific planning questions and concerns. Give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581, 616-301-2581. Quick break. We'll be back with more here on Your Course to Retirement in just a moment.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
And welcome back into Your Course to Retirement with certified financial planner, CFP Ron Corser, the founder of Cornerstone Retirement Partners. Grand Rapids, your resource for information, for guidance and perspective on your planning needs, on your money, on your retirement outlook, helping you to structure a plan so that your money works hard to help you achieve your goals into the future. If you've got questions or concerns, if you would like to get a plan put together or just double check and run a little bit of an analysis on your current plan, your investments, your accounts, pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581. Today on the program, talking with certified financial planner, CFP Ron Corser, and really examining some of what we know, what we understand, and what we've been taught about the market, and trying to make sure that we are basing our plan our structure and our goals for the future on sound, solid reality, and also identifying areas where the reality may differ a bit, separating some fact versus fiction about the market. So one of those areas, Ron, is that the market always goes up. We've talked about that. It doesn't always go up, but it has gone up over time. But another one, kind of diving a little deeper even, is that we can assume that we will make a stated rate of return in the market. I've heard that the market has always averaged 10% or 12% over time. What kind of credence, what kind of faith, and what kind of reliance in our personal financial plan and outlook can we put on that?
Well, I'm going to give that and say you can absolutely count on that if you don't ever have to take a dime out of your life savings for as long as you live in retirement. It's just money out there. Market will go up, market will go down. Over time, the market is always a little higher. So if you don't need any money out of your life savings, could be a good idea. You don't have to worry about market risk. Number two, if you think you got a handle on taxes, inflation, and all of that, and you're very comfortable with the pension and Social Security that you have, and you don't, again, need money out of your retirement plan, I guess you can assume that you're going to be safe and okay. But here's the difficult part. The difficult part is when we hear information that says over the last certain amount of years, the market's returned 10% or 12% or 1%. It's always important to ask, what are you measuring the base at? Where are you starting? If we start March 9th, 2009 through this year, even though we're in a tough time right now this year in the market and COVID was not pleasant, we've had a pretty good run in the stock market. If we go back a little farther, say to 2000, the year 2000, which is kind of rational. If we think we're going to live in retirement for 20 or 25 years or so, why not use just a little longer benchmark? We find that perhaps the stock market hasn't done as well as we had been told. So whenever anybody, myself included, ladies and gentlemen, says that over a period of time, the market has returned X number of percent, or this investment strategy has returned X number of percent, you should always say to me or whatever advisor you're dealing with, well, that's pretty good. Tell me what the base is. Where are we starting the measurement from? And that'll give you an idea, is it rational? Because if you're going to live 20 or 25 years or 30 years in retirement, do you really want to base a retirement plan on what happened the last 6 years? Maybe you do. Maybe you're a better risk taker than most people are. But let's take a look at some of the assumptions. Number one, there's a chart that I think we'll be able to show you that the index for the markets, going back to really 1996, that the actual rate of return has not been 12% on any 15-year period. What has it been? It's been a whole lot less. It's probably averaged a little over, just a shade over 5%. Any 15-year rolling period, the markets have returned a little over 5%. Now, that's not a bad number, is it? And ladies and gentlemen, if you want to see these slides, email me. Get on our website, www.cornerstone-rp.com, www.cornerstone-rp.com. We'll send you the slides. I want you to see the slides. This is not secret CIA stuff. This is important. So if you think the market has done that 5%, keep this in mind. That's a compounded rate of return, which seems pretty good, but it doesn't include taxes on investments. It doesn't include charges your investment advisor or us may charge. It doesn't include inflation. So is that 5% really real, or is it something less? Why is this important? Not to frustrate you, not to get you angry, not to get you scared, but to say the more information, we talked in the beginning of the program, one of the things we need is clarity. We need to really understand what's now, what's going on in the markets and what may happen down the road, and what is a rational way to approach our potential retirement strategy with a rate of return, with market volatility, with taxes, regulation, inflation, depreciation, you name it. We have to think about that. So that goes from January 1st, 2000 to December 31st, 2021. So there's 21 years of data, ladies and gentlemen. I want you to see the data. Please email me, call me, www.cornerstone-rp.com or 616-301-2581 and say, Ron, send me those slides. I want to see them. And we will do that.
A couple points, Ron, is that if we've got a plan that assumes and in some form relies on one expected rate of return, let's call it 10% or 12%, whatever you want to call it, and then in reality, we only achieve about a 5.78% rate of return, that is a very divergent outcome. If that happened in maybe just 1 year, it probably wouldn't impact us greatly. But this is the average rate of return, the true numbers of the S&P over what amounts to a 21-year period, that the average rate of return was not the 10 that we've been told or the 12 that we might like to expect, but more like 6%, a little under 6%. And so if our plan, if our forecasts for retirement had been relied on those more optimistic numbers and projections, then we are not achieving the destination that we had hoped for. Now, kind of point number two is that if we had been contributing over that period of time, over those 2 decades, then we probably experienced some significant growth on our money because we didn't just sit the money in there and let it ride. We were actually buying in at some of those low points and all along the way. And so those dollars actually probably experienced a much higher, much more significant return. But the dollars that were sort of already in there as we ended the year 1999 and entered into the year 2000, that has effectively been the rate of return on those dollars before we talk about any fees or costs or expenses.
Yeah, it's an important idea to hold very tightly to and have clarity on, is what's the real rate of return. Because you could say, okay, I can live with, say, 5% rate of return on my money. So if I have $1 million, I can scrape off 50,000 of that. I'm going to be good. I can live on 50,000, including Social Security and some other stuff. But here's the question I always ask. What happens if we have a 10% loss in the market, which would be normal? So all of a sudden we're dealing with 900,000 of the $1 million, and we still want that $50,000 off of that. That's a higher percentage. This leads me into a conversation. I'm just going to talk about it. This will make your head scream because I've done it to you before. I'm going off script. But what I just talked about a little bit is something called sequence risk. It's a risk that more and more people are talking about. What is sequence risk? It's the risk of losing money 3, 4, 5 years before or right after retirement. That's the red zone. That's 6 to 10 year period before and after retirement. Taking a loss, particularly a major loss. I'm not talking about 50%, which will destroy your retirement plan. I'm talking maybe a 20% correction, which would happen about once every 7 to 10 years, a real bear market. So you take your $1 million down to 800,000, you still need that 50,000, have it go up every year. Man, all of a sudden you're starting to withdraw a whole lot more money from your retirement plan, and it's going to be very, very difficult for you to get back to even. So that's another conversation we can have. But sequence risk is an important risk that we deal with when we create retirement plan strategies, income strategies for clients. We have to deal with sequence risk. It's out there. Nobody talks about it. It's one of those risks that if it happens in your portfolio, you're not aware of it until 3, 4, 5 years after you've taken the loss. So that's something to think about. So let's think about this too, because we've touched on what's the real rate of return, avoiding sequence risk. Why do we talk about these things? Because that's all built around, we have to create a retirement income plan. I mean, isn't that why we're saving money, to have income in retirement? And we're trying to create a retirement income plan. Now, here's something we can offer everybody, whether you're a client or not a client. And man, I would take us up on it. We have the ability, we use software to do it. We have the ability to say, this is your life savings. This is where you're taking the money from. This is how much income you're getting every month. This is how much you have to pay bills and things like that. Here's your current investment strategy. We can put all that together and pretty reasonably and accurately tell you if the plan you have is going to survive your lifestyle and is going to survive your lifespan. Wouldn't it be nice to know if what you're spending now, what you're taking out of your retirement life savings, given all the uncertainty, given all the way you're invested right now, wouldn't it be nice to know if that plan is going to work? Not just for a year, but 5 years or 10 years? Wouldn't it be nice to know? So here's the offer I'll make to you, ladies and gentlemen. If you would like that kind of information, if you would like to know whether you're a client of ours or not a client of ours, if your current retirement plan will basically survive the test of time, so to speak, given current things going all around us, we will do that work for you. We will help you understand if what you're doing now is going to succeed, or if it maybe has a couple chuck holes or potholes out there that you perhaps were not aware of. Critically important information to know. So give us a call, 616-301-2581, or go to our website and say, Ron, I want to know if my retirement plan is going to last longer than me. And we'll get a hold of you. We'll get the information we need. We'll run the analysis for you. We'll provide that information to you. And I think once you see it, you're going to say, wow, I'm in good shape. I can rest easy. Thank you, Ron, for doing this. Or, wow, I didn't know that. What do I got to do here to make it a little better? Either way, you're going to win. So give us a call if you want this kind of help and information, 616-301-2581, or go to our website, www.cornerstone-rp.com.
Again, that's www.cornerstone-rp.com. And just to repeat and reiterate that if you are listening to the radio program, there is much more to find on the website. We'll include some of these slides and resources and links to certain references that we make throughout this program and others on that website and in the videos and links and descriptions below the podcast. So visit cornerstone-rp.com, or if you'd like to get that plan put together, double check, run a forensic financial analysis on your current plan, or just have a discussion and a strategy session. Pick up the phone and give Cornerstone Retirement Partners a call, 616-301-2581. That is 616-301-2581. Now, I'm going to play a little bit of the devil's advocate position here, Ron, and again, allow you to help us separate fact from fiction. I'm going to say, well, that Ron, for those numbers that you just gave, for that example, you chose to include a particularly rough patch of time. The dot-com bubble was particularly rough. The 50% correction that happened in the 3-year period from 2000 through 2002. The Great Recession, that was a particularly rough period of time. The 50% or so decline that happened from 2007 to 2008. But those times are rare. That was an anomaly. The market typically goes up, and those kind of bear markets almost never happen in the market. Now, that's a lot of people's understanding when we hear that the market has always gone up over time. First, could you define what a bear market is, and then talk about whether that is a realistic expectation, or if we need to maybe examine reality?
That's a great lead-in. What is a bear market? A bear market is a market where there's at least a 20% loss in value of the market. Now, real bear markets take place somewhat quickly and then slowly over time. So let's go back to March 2022 or 2020 when COVID hit. From January 1 to 31 March in that first quarter, the market was down 22.1%. COVID hit and the market went down 31% 11 days. So all of a sudden we thought we had a bear market. Boom, it went down to over 20%. And then the government absolutely loaded up its money guns and threw $6, $7, $8 trillion at the market, and it bounced back. So that was considered more of a correction. A real bear market is something that does go down over a period of time, short period or longer period, at least 20%. And it lasts for an extended period of time, maybe 9 months to 18 months. That's a bear market. Bear markets happen averagely one every 7 or 8 years. Sometimes we have them quicker, like we had in 2000 to 2010. Sometimes we have them farther away, but they're always out there. We've had 16 bear markets in the market since 1929.
16.
That's 16 opportunities to just blow up your retirement plan. The problem again is if you have to take money out of your retirement plan to live, that sequence risk of those bear markets will absolutely create all kinds of stress on your strategy. That's why you need to factor in those kinds of things. So bear markets are not markets that happen quickly like happened in COVID. That's considered a correction. And most of this stuff you find out by looking in the rearview mirror. You know, we never know, do we? Oh my goodness, the market went down 2% one day. Does that mean this is the beginning of the end or the end of the beginning? I don't know, look in your backyard. If you see zombies out there, that's probably not a good sign. But bear markets can be horrible, and bear markets are the kinds of markets that absolutely bring the whole idea of sequence risk into play. So it's important to plan for them. You know, I joke with people sometimes. We've all heard of O'Toole's law, right? O'Toole's law said that what can go wrong will go wrong. Well, that's Murphy's law. Well, O'Toole's law says Murphy's law is optimistic. That's really scary, isn't it? So you got to plan for these things. Can you do it perfectly? No, but you can do it really well. You don't have to expose yourself to a major correction and the impact it has on devastating potentially your retirement strategy. So understand that bear markets do happen. They are somewhat rare. We've only had 16 since 1929. But man, every time it's happened, it's been a terribly ugly situation. And it's been uncomfortable, and it's created a lot of stress in people's lives, along with basic losses. So if some of this you want to help with, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Remember, we started this program by talking about we need certainty, we need the ability to recover losses if they happen, and we need clarity on what's going on. When we have those three working together, you're able to sleep at night a little more. You're able to not worry as much. It's like, okay, I've touched on a lot of this. If the world kind of gets shaky, I'm going to be okay because we've created a strategy in retirement for you that will give you the income you need, no matter what happens to the stock market. And it won't destroy your life savings, and it won't destroy your retirement plan. So if this kind of certainty and peace of mind is important to you, give us a call, 616-301-2581, or go to our website, www.cornerstone-rp.com, and we will help you with these kinds of things.
A few things I want to touch on there, Ron. One is you mentioned how the money shooters came out during the last downturn after coronavirus and COVID first hit. I feel as though because it worked once and because it received so much bipartisan support to send checks out to every household, that may become more par for the course into future economic downturns, that may become the de facto government response. Also want to point out that as humans, our psychology, we tend to have recency bias, meaning the most recent round of what we have seen, we sort of tend to believe that's what everyone is like. And we bounced back rather quickly from COVID. And so there is the perception that, well, that's how markets behave and we'll come back just as quickly from the next one. But if we look back, many of those downturns have been much more protracted and longer term. I mean, you're going back to 1929 with these 16 different downturns, these 16 different bear markets. Some of them did last for decades before we rebounded and got back above our starting point. And then finally, just the impact of a loss. And my analogy here is I can remember back in my school days that I was a pretty good student, and I had a class where we had 10 quizzes, and I had done very well on all of them. I had gotten 95s and 100s on all of them. And then at the end of the quarter, I saw my grade and it was a C. And I went to the teacher and I was like, well, what happened? How I got good grades on all of these quizzes? And she said, yeah, but you missed that one quiz and you never made it up. I got a single 0 and it brought my grade down to a C. She actually gave me the opportunity to make it up for half credit, and it brought my grade back up to an A. But one large 0 there, one large loss. And in the market, we're not talking about just zeros. We're actually including negative numbers here. But that one bad number had such an impact. And so that's what we need to think about as we are considering what downturns, what losses in the market can do to our projection and our outcome.
Well, let's go back to all the spending that the government did for COVID. Depending on who you listen to, they put $6 trillion to $9 trillion into the market in various places. The market bounced back. Do we have inflation now?
Sure do.
See, there's no free lunch. There is no free lunch. There's no one solution that's going to fit every problem. But the government and the Federal Reserve has put themselves in a position since 2008 where their solution to every problem is to print more money and put it into circulation. That finally has created some inflation, which is not healthy. And inflation is, it's one of those things you don't stop right away. And it's impacting. So somebody can have a 10% rate of return last year on their portfolio. Inflation is now 7.5, maybe 8. It's pretty much a wash, isn't it? So sometimes the solution creates other things that impact us. It creates, remember we talked at the beginning of the program that we needed some certainty. We needed clarity. Certainly, we know there's going to be financial problems. So when we think about a loss, there's 2 responses that I always hear. I've been in this business almost 27 years now. Responses to losses, market corrections. Well, everybody lost. We seem to take solace in the fact that we're all in a sinking ship. You know, when we're all on the boat, they hit the iceberg, we're all in this together. You know, no, we're not all in this together. It's kind of like the COVID thing. Everybody was saying, well, we're all in this together. No, we're not all in this together. So that's one response I get. Well, everybody lost. And then when I say, well, did everybody lose the same amount? Well, yeah. No, that's not true. It's not simply true. So the other part to loss is that people say, well, I guess I can take a little bit of loss because you have to risk money to make money. I say, you know what? I guess that's true. Because when you go into the casino, you have to risk money to make money. But herein lies the problem with that one. What if the odds are against you? What if no matter how long you stay, you potentially can't do that? So let's talk real briefly about losses. Let's say you have $1 million, Peter. I love to talk about all the money you have. You got $1 million and you all in the market and you lose 20%. You get into a bear market. All right, it happened. So your million went down to 800,000. What does the stock market have to do to get you back to even? It has to go up 25%. 25%. It has to go up. Percentages are really weird things. So you lost 20%, but you get back, see, to get back $1 million to 800 is a $200,000 loss is 20%. Now you got to take your 800,000, move it back up to $1 million. You need another 200,000. 200,000 on top divided by 800,000 is 25%. It's 1/4. So that's why losses always seem to happen a whole lot quicker than recovery and gains. So the key to successful investing over time is to minimize losses. It's not what just Ron Corser believes. I mean, Warren Buffett believes it. What's his number one objective in investing? He said, don't lose principal. What's number 2? See rule number 1, don't lose principal. Well, he's got gazillions of dollars. He doesn't have to worry too much. But for us normal folks, taking a significant loss is an impact. Particularly if, Peter, you were taking money out of your portfolio, out of that $1 million, it lost 20%, it went down to 800,000. but you're still having to take out that $50,000 a year you need to maintain your lifestyle. That's sequence risk in spades. It's going to be very difficult for you to recover to get back to even. So the impact of losses is real. Now, ladies and gentlemen, here's the caveat to all of this. If you never need to take a dime out of your life savings, you got a pension, you got Social Security, you got a whole bunch of other stuff going on, you're good, and you don't have to take a single dime out of your portfolio. A lot of what we just talked about is nonsense. Because if you're never going to use that money, it's just out there somewhere like Scrooge McDuck. Market's going to go up, market's going to go down. Statistically, 20 years from now, the market will be higher. So which means you'll have more money. The problem comes when we have to deal with taking income out of our retirement life savings, and we have to deal with keys issue, taxes, inflation, regulation, those kinds of things that impact our lifestyle. Those things impact our lifestyle, which means if taxes go up, regulations get worse, inflation gets more, that 50,000 that you need, maybe you not got to take out 60,000 just to stay even with your lifestyle. Then your life savings really get stressed. So ladies and gentlemen, one of the key issues here is, given whatever plan or strategy you have going on right now, would you like what Peter called a forensic analysis to find out if what you're doing now is going to survive what's coming down the road the next 5, 10, or 15 years? If you would like that kind of help, that kind of information, give us a call at 616-301-2581 or go to our website, www.cornerstone-rp.com. We can do that work for you. We can bring certainty into your life, into your plan. And with certainty comes, yeah, I got some clarity. I got a way. I know that if I stay in the market, I'm going to have some bumps, but I got a way to recover those bumps. But overall, if you have clarity, certainty, and a way to recover, you're going to have a great deal of peace of mind that maybe you don't have now. So we can do that forensic analysis for you. Give us a call at 616-301-2581 or go to our website, www.cornerstone-rp.com. Let us help you. We're willing to do that.
Well, great conversation. Fantastic insights from CFP Ron Corser. Ron, I see us continuing this conversation because you've got about 10 more lines of financial fact versus fiction when it comes to the market that we did not have time to get to. We'll have to cover that in a future segment and edition of the program. But thank you for all of the guidance that you provide for Grand Rapids area savers and investors, kind of the dose of common sense and reality, and for being that resource that savers and investors can turn to proactively to get plans put together. Ladies and gentlemen, that's the true value of the program, is a reminder that you have this resource there at Cornerstone Retirement Partners. Pick up the phone, give them a call, 616-301-2581, 616-301-2581, or go online, cornerstone-rp.com, cornerstone-rp.com. Once again, we appreciate the time, Ron. Thank you for being here. Good to see you as always.
Well, thank you, Peter, and thank you for everybody listening to today's program. I wish you a blessed Sunday, and we'll talk to you next week.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured